We start today's market talk. Markets are a reflection of the economy. Sometimes they are honest mirrors, and sometimes they are mirages. Few weeks ago, Indian markets were at record highs. Now there are macro, micro, and geopolitical concerns, and all indices have corrected 10% plus from their peaks in September. So the market outlook. Indian equity indices took a beating, exchange rate wobbled, trade deficit increased, domestic inflation data has reduced, policy easing hopes, and there is a growing concern around consumption demand. So this is the macro issue. Now coming to geopolitical, Trump repeated his America First campaign in which he is moving towards imposing steep tariffs on trading partners, reducing corporate taxes, booting out immigrants from the US, and pushing climate change aside. While micro issues, corporate earnings have not met expectations and a cyclical slowdown in the economy is underway. India's stock market should reflect that, and finally, they seem to be. So, what all has changed? Firstly, re-election of Trump has triggered a rush of global capital moving back to the US. Combined with marked deterioration in earnings, it has taken the wind out of the Indian stock market. Second is persistent selling by FIs. They have withdrawn roughly $14 billion since beginning of October. This correction reflects growing concern and caution amid rich valuations. All emerging market assets are under pressure due to dollar strength and emerging market currencies have depreciated. Indian markets were priced to perfection and lackluster earnings season has added to nervousness of investors. October retail inflation came at 14-month high at 6.21%, dampening hopes of interest rate cut by RBI in near future. The most critical issue is that the earning miss is secular. It's across all sectors and stocks, except for banking and IT. Urban demand is slowing in discretionary spends, while rural demand is looking up but can't offset the urban slack. In addition, the trade deficit was higher than estimate. Now, as power demand rises and capacity expansion ramps up, the government is set to widen the scope of its PLI scheme to include power transmission equipment. Growing disparity between supply and demand has led to soaring prices for transformers, circuit breakers, and switchgear. Now, green energy projects and making big green energy projects without transmission network is a total waste of effort. Coming to weekly data, Bank Nifty corrected. Gold also corrected as dollar became strong and silver in addition. Crude oil corrected because there is a weak demand expected. Natural gas went up because the winter season there is expected to be higher demand. Dollar strengthened. Now it has reached nearly 107 levels. USD INR also uh, depreciated only. The rupee depreciated against dollar. Now it is at 84.5. 10-year bond yields in India also went up because the rate cuts possibility have been delayed. NSE lost around 3% in market cap. Basically, because of all pervasive selling in equities. Market-wide position limits were up, but lower than what is there at this time of the contract. Basically, because people are not taking a position because they're scared. Dow Jones, Nasdaq, and S&P 500 all corrected, basically due to last one or two sessions where the concerns about inflation and future rate cuts have increased. Now coming to US, focus shifted back to economic data and Fed from Trump. Consumer and producer inflation data was higher. Fed Chair Jerome Powell on Thursday suggested that central bank would not be in a hurry to lower rates. So if you see the US 10-year yield, it, it had gone up to 4.5 plus levels and then it corrected after the upward trajectory. but it made a bottom and now it is rising. Now it is above all the 20 and 50-day moving averages on the weekly charts. And now it is nearly reaching 4.5 level. And post the Powell's commentary, it is expected to go up higher. Dollar index is making fresh highs. Now, after it went into that supply zone or demand zone, sorry, at around 100, it has bounced back nicely from there and now it is nearly reaching 107 levels. Brent crude is correcting because there is expectation of a lower demand from India and China. Gold has corrected and has now come and taken support at 20 EMA, and it is expected to go down further as the dollar continues to maintain its strength. Copper has also corrected as expectations of a demand of industrial metals is not very high because of weak China stimulus, and rest of the emerging markets also not showing any growth. Nasdaq corrected after it had made a top at around 21,000. It corrected last week. Similarly, Dow Jones also topping 44,000 corrected last week, nearly 500 points. Coming to Indian markets, VIX has VIX, which went up 1 odd day, came down sharply after all the events are priced in. Now coming to Nifty, this is a weekly chart. So if you see here, Nifty from the base it made on 4th June had risen up to 26,370 odd levels. So it has roughly retraced 50% plus. Maximum it can retrace 50 or 61%. So roughly the first possible target should be around 23,200 levels, which is 61%, 61.8% retracement. And then a bounce is likely. Coming to daily charts, this first big selling was in June, then in August, where it corrected, then in October, where at the high it made a evening star pattern, and then from there it corrected, and then there has been a big correction in November also, where it has come down to 200 EMA. Last time it took support at 200 EMA only, but after that it had risen to 26,000 plus. Now let's see what happens from here. On daily charts, it is oversold. On hourly charts, if you see throughout the week, Nifty has been below the 20 EMA also. So there is no strength. And for large portion of the time, it was oversold, but there was no bounce which was seen. So there is no momentum as such. Nifty Bank broke the 20 EMA on the weekly charts and has corrected and now has come down to 50,000 levels. On daily charts, if you see, it was in a box or a rectangular pattern since October. But this week, the box broke on the downside. So this indecisive period has been over and now it is exactly poised at the 200 EMA, which is somewhere close to around 49,880. HDFC Bank, which was keeping the Nifty Bank high, corrected last week. And in 2 days only, it came down from 1780 odd levels to around 1680 levels. 100 points, 100 rupees was gone in just 2 days, and that brought the Nifty down. Reliance, if you see here, it has given back more than 61% now. So it is below the 61% retracement of the complete rise, which took it to the 1600 levels from 1100 levels, which it had come down to last year to 1600 levels. So it has retraced now 61% and if it retraces 61%, it may retrace to next support, which is at around 1225 or come down completely to 1100. So just be careful with this. On even weekly charts now, it is nearly oversold levels. Midcaps also corrected roughly 4% and have come down to the high they made on 4th June. This is a critical level. So the whole rally for the last now 5-6 months is finished now. So all the improvement in the prices which had taken place in the last 5-6 months is gone. Similarly, with small cap index, they are also at similar level, and the gains which was there in the last 5-6 months are gone. Now I'll cover three stocks today. First is Triveni Turbine. It manufactures industrial steam turbines up to 100 megawatt and refurbishes rotating equipment at its state-of-art facilities. It offers steam turbine solutions for industrial captive and renewable power. It reported a revenue EBITDA PAT growth of 29%, 50%, and 41% year-on-year in second quarter FY25. Domestic order inflows grew at 4% year-on-year as inquiry generation in the preceding 2 quarters was impacted by elections. Export ordering growth continued to be robust at 50% year-on-year. Domestic order inflow pipeline will see an uptick in ensuing quarters with healthy inquiries from distilleries, municipal solid waste, cement, steel, process cogeneration, chemicals, petchem, etc. Closing order book at rupees 1790 crore, plus 22% year-on-year. The foray into US market provides it with vast untapped opportunity potential, with US having the largest installed base of turbines and other rotating equipment. Company has made inroads in higher range of turbines above 30 megawatt, API turbines and refurbishment jobs, which has facilitated robust growth in order inflows and revenues. Now coming to their quarterly earnings. So if you see here, net sales year-on-year rose around 29% and was much higher than the estimates by around 3%. Similarly, EBITDA margins were also better, and that took the profit up around 41%, much higher than 31% profit growth, which was expected, and margins also improved. Order book is up 22% year-on-year. Order inflow moved up 25% year-on-year, which is positive. Roughly 500 crores of orders last quarters were added. Revenue growth stood at 29% year-on-year. So they have now reached that 500 crores of revenue per quarter and is expected to improve from here. And share of aftermarket has remained stable, roughly 165 crores. So this is roughly around 33%. Export share has largely been stable. So they have reached now around 40% plus levels of exports, which gives them a revenue stability. EBITDA margins saw a healthy improvement. So they have now stabilized and have come to around, EBITDA margins have come to 20 plus levels. EBITDA growth was 50% year-on-year, which is very strong because of better margins, and PAT growth was 42% year-on-year. Order inflow momentum to improve in the coming quarters. So both domestic and export orders are expected to improve over the next few years. Order book on strong footing led by healthy inquiry levels and foray into newer markets. Overall revenue to post a CAGR of 29% over the next 3 years, and it has made healthy foray into service. So after as percentage of sales, so service revenues are roughly around 15 to 20% of the total sales. EBITDA margins should be in this 21 to 22% range, and PAT CAGR expected around 32% over the next 3 years. Expect asset turnover of approximately around 7x, which is improving over a period of time, and return ratios to remain strong on healthy profitability. So they are expected to do roughly 26,553 crores of revenue in FY26. So it will improve around 30% year-on-year. EBITDA margins are expected to be around 20% plus, and PAT is expected to 456 crores and improve by around 24% year-on-year. So they will do an EPS of around 14.3 in FY26 and 19.5 in FY27. So taking a mean of around 18, this can easily trade between 40 and 50 times. So from 720 to 900, it's an easy level for this stock trade. ROE, ROCE are improving. Asset turnover is improving, and there is no debt as such. So net debt to equity is positive. So this stock has corrected to the 200 EMA and has come down to around that 617 level. At these levels, it is pretty attractively priced and should be accumulated from here. Next stock I will cover is Minda Corp. It is one of the leading automotive component manufacturing companies in India with a pan-India presence and international footprint. It has diversified product portfolio that encompasses wiring harness, lock sets, instruments, clusters, die casting, EV parts, sensors, starters, alternators, etc. It is a top one supplier in two-wheeler CV tractor wiring harness, top one, top two in two-wheeler electronic mechanical lock sets, top one in CV tractor instrument clusters, and is improving position in EV parts, sensors, and sunroofs. Company has a powertrain agnostic portfolio, and EV transition will be key growth driver in the long term, with a potential increase in kit value by 5 to 6x for two-wheelers. It has announced new lifetime orders of rupees 2,400 crores for second quarter FY25, with EV comprising around 25%, with total order wins for H1 FY25 at 4,750 crores. So that means it is roughly getting around 2,500 crores of orders, fresh orders per quarter. It remains a strong play on premiumization, regulatory changes, and EV penetration. The company recently entered into a technology licensing agreement with Sanko China to manufacture EV connecting systems, charging gun assemblies with sockets and accessories, bus bars, cell contact system, power distribution units, and battery distribution units. It, along with HCMF Taiwan, setting up a new plant in Pune for sunroof systems, likely to be commissioned by Q1 FY26. It has built scale and technical prowess through global tie-ups, Stoneridge, VST, Infac, and EVQ Point. Now, seeing their quarterly results, the revenues were up year-on-year 7.9% and 8% Q-on-Q. EBITDA was up around 11% year-on-year and decent growth, and 11% Q-on-Q also. And adjusted profit was up 26% year-on-year and 15% Q-on-Q. So what they're expected to do is they're expected to grow around 15% year-on-year in terms of their revenue, and reported profit is expected to be around 400 crores in FY26, with the EPS of around 17 or this thing, and FY27 around 20. So taking a mean of around 18 or 19, say let's take 19, this can easily trade at 20 to 30 times. So at 20 times, it comes to around 380, and 30 times, it comes to around 570. So that should be a decent level. Between 500 and 570, this should be a decent level to accumulate this stock. EBITDA margins are improving. The revenue growth is decent, around 14-15%, and profit growth is higher because of better margins, better EBITDA growth. ROE, ROCE are improving. EPS growth is expected to be around 28% in FY26, and PE has come down. So if you see here, key assumption is 13% CAGR over the next 3 years, with all segments growing in nearly double digits. Wiring harness, lock set, die casting, and clusters and others, everything is likely to grow at around double digits. The stock has come down to around 470 level at 200 EMA. So this is a decent level to accumulate the stock. It can easily trade at 500 plus 550 to 600 levels, where it had earlier traded at. Now it is corrected because of weak markets. Next stock I will cover is Swiggy. It offers users an easy-to-use, convenient, unified app platform to browse, select, order, and pay for food delivery, groceries, and household items via Instamart, with orders delivered to doorsteps through on-demand delivery partner network. It also offers restaurant reservations via Dine Out and event booking via Stepping In Out. Other offerings include product pickup, drop-off service via Jenny, and other hyper-local activities via Swiggy Minis, and among others. QC platforms, Blinkit, Instamart, and Zepto are now increasingly diversifying into all immediate commerce needs like everyday essentials and impulse purchases. It has solved one part of the unit economic equation, that is GOV to sales density. So it works very nicely in areas where there is density of population is high, so that they are able to generate higher GOVs from same blacks from the same stores, dark stores. But contribution margins are anemic currently, minus 3 to 4% of the GOV, and insufficient to cover the high fixed cost, dark store rents, utilities, manpower, last and middle cost. The existing incumbents have recently spruced up their cash positions between Zomato, Instacart, and Zepto. Their cash pile stands at 40,000 crore to aggressively add dark stores over the next 2 to 3 years and defend market share against entry of deep-pocketed offline scheduled delivery retailers. In food delivery, players have settled into a cozy duopoly. The scale difference, Zomato is 30% bigger than Swiggy, can be explained largely due to MTU, that is monthly transacting users, which are much higher for Zomato, and city presence. Sustenance improvement of food delivery profitability has become even more imperative now, as it is likely to act as a lever to balance company level operational cash burn in the event competition in the quick commerce segment gets intense. FY 22-24 marked a phase of driving efficiency for Zomato, wherein operations were withdrawn from lower user density cities, restaurant delivery partner order densities, and ATU to MTU conversions were improved upon, and consequently, monthly order frequency and AOV, average order value, improved. Now, coming to detailed comparison, Swiggy has lost gross order value share across both food delivery and as well as quick commerce. So if you see here, it has lost market share in food delivery. So right now, Zomato is 58%, while they are 42% over a period of time. And similarly, in quick commerce also, where the market share has been basically taken up by Zepto. IPO money would essentially will be used in improving the position in quick commerce by opening more dark stores, etc. So they are expected to use this money to open more dark stores and improve their GOV and gross revenue over a period of time, next 2-3 years. And stake rate would be stable at around 20% out. Quick commerce incumbents, if you see here, the years they were launched, Swiggy 2021 and Zomato was launched in 2014. They were earlier growers, and Zepto in 2021. So in terms of GOV in billions, so that means they are roughly 8,000 crore, 12,500 crores, and 6,400 crores. So roughly they are at around 26,000 crore total GOV. Per dark store, it is lower for Swiggy as compared to Zomato. Number of dark stores is also slightly less, which they're trying to improve. They are also in slightly lesser cities. Zomato is in the highest number of cities. SKUs offered are also lower, and contribution margin is much lower. So for Zepto, it is the highest, and that is why they are not EBITDA positive, adjusted EBITDA positive. They have raised a lot of cash in process of for growth and defending market share. So right now they have been raising that is both Zomato and Swiggy have raised cash. Swiggy through IPO, Zomato is doing QIP, and Zepto has also raised cash. So they have now adequate money to defend their market share by adding more dark stores and giving more discounts. Instamart has lost ground since launch. Blinkit continues to better its relative market share. So if you see here, quick commerce market share has improved for Blinkit, while it has been remaining, Swiggy has been losing, while Zepto is gaining a little bit market share. Warehouse capacity across key retailers in India, Amazon, Flipkart, etc., Reliance have roughly around 50 million square feet, while these guys have, Blinkit and Swiggy have roughly around 4.8 and 2.7 million square feet. But these guys have higher scale of businesses also and have bigger products as compared to what these guys are selling. While Swiggy has been improving its order GOV sales densities, Blinkit has zoomed past it on efficiency, and that is why their GOV is much higher. So if you see here, GOV per day per store, Swiggy is around 58% now of Zomato. So that is where their efficiency is lower. And orders per day per store also, uh, in number of orders also, the Zomato has reached that break-even point of around 1,500 orders uh, per day, while Swiggy is still lagging behind in terms of both average order value and number of orders per day, and that's why they are not profitable. Uh, at current scale and fixed cost, Instamart needs 2,000 orders per day per store to hit EBITDA break-even, while Blinkit is nearly at 1,500 orders per day per store, and roughly that is there for Blinkit, that is their break-even point. So if you see here, uh, if they do orders per day per store, 2,000 orders, right now they're doing around 1,135. So if they do around 2,000, they will break even and increase their average order value to around 585. Then it will take care of their fixed cost as percentage of GOV, and the contribution margin will also improve. So then they will break even. While because they are more efficient, Blinkit is breaking even at 1,500 orders per day because the average order value is around 650 rupees. So because of that, they are able to break even. To break even, GOV per day per store, which is required, is around 11 lakh for Instamart. For Blinkit, roughly around 9 lakh 75,000 should be uh, good. Now, related market share in food delivery. Now, we have covered quick commerce. So, coming to food delivery, again here, Swiggy has been losing market share to Zomato, and average MTUs, that is monthly transaction users, are also much higher for Zomato versus Swiggy, and improving in a much better, faster way for Zomato versus Swiggy. Zomato continues to catch up on ordering frequency and average order value. So the Swiggy has come down in terms of monthly order frequency per user, while for Zomato it has been improving. And average order value for Zomato is much higher, where they are gaining market share. Across all input variables, Swiggy has led Zomato catch up on efficiency, be it order density, etc. So, in number of cities, Zomato is in higher number of cities as compared to Swiggy, and orders per city also, they are much, much higher. Now, food delivery unit economics, if you see now over a period of time, they have become profitable. So average order values are now stable at around 400 plus rupees. So they are gaining 100 plus rupees revenue per order. Considering all other factors and cost and other issues, so contribution profit is now stabilized. So they are becoming profitable considering their fixed costs, etc. So per order, if you see here, in Q1, Zomato is making 15 rupees and Swiggy is now just become profitable and gaining 4 rupees. So if they become more efficient, they will make more money per order. So this has to be seen. Now, Swiggy, if you see here, uh, they are adjusted EBITDA negative, and it is expected to come down over the next 2 years or so. So by FY27 only, they are expected to become profitable. So market will watch for this. So if there is a slack in this, then the stock will correct. And if it gets preponed, becoming profitable, then the stock will also become more pricier. Peer valuation wise, if you see, the sales growth for Zomato, the sales are much higher, and the sales growth are expected to be in a range of 60 to 42%, etc. It's for Swiggy, they are in that mid 20s range, and that's why Zomato becomes EBITDA positive and margins are better. Swiggy may become profitable in FY27, that is EBITDA wise, and still, but net profit may not be there. So seeing the total thing in FY26, out of the total GOV, the major part is going to come from food delivery only, and the bigger share which is improving is coming from quick commerce, while out of home consumption is going to be much lesser. So this is the way, and the growth which is expected is around overall 34% over year on year, while quick commerce is expected to grow at 58%, and that is the fastest growing part of the business. Adjusted EBITDA, as I have discussed in FY27, they may become positive. So expect quick commerce to do most of the heavy lifting in GOV over the next 3 years. So the incremental revenues in GOV are going to be higher for quick commerce vis-a-vis food delivery and out-of-home consumption. So the gross revenue mix in terms of first half FY25, it is basically food delivery is 50% for them, and supply chain and distribution is 36%, while quick commerce is just 12%. Take rate in core FD and QC are improving. Improving mix in QC and better fixed cost absorption with scale should aid profitability and return ratios over the next 3 years or so. So their ROE, ROCE, ROIC, etc., is going to improve over the next 3 years, and that is expected as such. So Swiggy has lost ground in food delivery and QC. That is the thing. It has to add monthly transaction users in food delivery, or it will lag Zomato. Instamart fixed cost absorption is lower as GOV per order density, AOV, MTUs are lower. Now, QC's quick commerce has solved problem of demand aggregation across dense micro markets, which pays a premium for convenience. Now, dark stores are roughly 2,500 to 4,000 square feet in 1 to 3 kilometer distance radius in dense population neighborhood. GOV per dark store is roughly 4 lakh to 10 lakh per day, but it is still 3x the revenues of DMart per square feet. So roughly, if you see the rough calculation, they need 600 plus average order value and roughly 1,500 orders per day to become to break it. So this is the basic unit economics. I have finished. We will take questions now.